walked away from that even, I mean, just thinking that we really, the best thing we can do for the U.S. is to restore price stability, fully restore price stability and not fail in that task, and do it as quickly as possible, but also with the least damage we can.
Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. You've spoken before about the pain that would likely be coming for the economy in order to get inflation down. But since the economy has not responded to rate hikes in ways that would normally be expected, have you changed your views on that at all, on how necessary or inevitable that kind of pain would be, say, for the labor market or overall growth?
Well, I think everyone has been very gratified to see that we've been able to achieve, pretty significant progress on inflation without seeing the kind of increase in unemployment that has been very typical of rate hiking cycles like this one. So that's a historically unusual and very welcome result. And the same is true of growth. We've been saying that we need to see below potential growth, and growth has been strong, but yet we're still seeing this. I still believe, and my colleagues, for the most part, I think still believe that it is likely to be true. It is still likely to be true, not a certainty, but likely that we will need to see some slower growth and some softening in the labor market conditions to get to fully restore price stability. So, but it's only a good thing that we haven't seen it, and I think we know why. Since we lifted off, we have understood that there are really two processes at work here. One of which is the unwinding of the distortions to both supply and demand from the pandemic and the response to the pandemic, and the other is restrictive monetary policy, which is moderating demand and giving the supply side time to recover, time and space to recover. So you see those two forces now working together to bring down inflation. But it's that first one can bring down inflation without the need for higher unemployment or slower growth. It's supply side improvements like shortages and bottlenecks and that kind of thing going away. It's getting a significant increase in the size of the labor market now, both from labor force participation and from immigration. That's a big supply side gain that is really helping the economy, and it's part of why GDP is so high, is because we're getting that supply. So we welcome that, but I think those things will run their course, and we're probably still going to be left, we think, and I think, we'll still be left with some ground to cover to get back to full price stability, and that's where monetary policy and what we do with demand is still going to be important.
I'm curious against that backdrop, if you've gotten any clarity on lags, if you have an economy that's been so resilient to high rate increases, does that suggest to you that there isn't necessarily this huge wave of tightening that's still coming through the pipeline and that it may have already come into effect?
I continue to think it's very hard to say. So it's been 1 year at this meeting. 1 year ago, this was the fourth of our 75 basis points hikes. So that's a full year since then. I think we are seeing the effects of all the hiking we did last year, and this year we're seeing it. It's very hard to know exactly what that might be. But you can, for example, an example of where you wouldn't have felt this yet is debt that had been termed out. But it's going to come due and have to get rolled over next year or the year after. So, and there are little things like that where the effects are just taking time to get into the economy. So I think we have to make monetary policy under great uncertainty about how long the lags are. I think trying to get a clear answer and say, oh, I'm just going to assume this, is really not a good way to do it. And this is one of the reasons why we have slowed the process down this year, was to give monetary policy time to get into the economy. And it takes time, we know that, and you can't rush it. So slowing down is giving us, I think, a better sense of how much more we need to do if we need to do more.
Michael McKee from Bloomberg Television and Radio. I'm trying to connect the dots here. One quick clarification I want to ask about Rachel's question is, you said you need slower growth. You had always said before a period of lower than trend growth. Has that changed? And two, it sounds to me like you're basically saying here that the kind of the dot plot's out the window, that every meeting is live with the possibility of a rate increase for right now, doesn't matter about the turn of the year, and that there's not an objective way to determine whether or not you've got enough tightening in the system. It's just going to be a subjective judgment meeting by meeting.
Well, so let's talk about the dot plot first. So the dot plot is a picture in time of what the people in the committee thinks is likely to be an appropriate monetary policy in light of their own personal economic forecast. In principle, when things change, that's not like a plan that anybody's agreed to or that we will do. That's a forecast that would change, for example. I mean, many things could change that would cause people to say, I wouldn't write down that dot, 6 weeks later. Think of the number of things that could change your mind on that. So I think the efficacy of the dot plot probably decays over the 3-month period between that meeting and the next meeting. But nonetheless, it's out there, and we do personally update our forecast, but we don't formally update the dot plot. So, I think we try to be as transparent as we can about the way we're thinking about these things. We're laying out there our thinking, and as we approach the meeting, we'll all be, my colleagues and I will be talking about how we're processing that data. In terms of, we're not really changing the way, in terms of growth, what I said was below potential. So what you have here recently is growth that is temporarily, potential growth is elevated for a year or two right now over its trend level. So the right way to think about it is what's potential growth this year. People think trend growth over a long period of time is a little bit less than 2%, or I would say just around 2%. But what we've had is with the improvement in the size of the labor force, as I mentioned, through both participation and immigration, and with the better functioning in the labor market, and with the unwinding of the supply chain and shortages and those kinds of things, you're seeing actually elevated potential growth. There's catch-up growth that can happen in potential. And that means that if you could be growing at 2% this year and still be growing below the increase in the potential output of the economy. I hope that's clear. That's really what's going on. That's why I would say it as below potential.
But if you could clarify what I asked about meeting by meeting, are we essentially now supposed to assume that it's a meeting by meeting, live meeting with a chance of a rate increase that will be decided on subjective criteria rather than objective at each meeting? I don't know that I want to just accept anybody's characterization of it. I'll tell you how we're doing this. So we're going meeting by meeting. We're asking ourselves whether we've achieved a stance of policy that is sufficiently restrictive to bring inflation down to 2% over time. That's the question we're asking. We're looking at the full range of economic data, including financial conditions and all of those things that we look at. And then we've come very far with this rate hiking cycle, very far. And you saw the spread at the September meeting of, it's a relatively small spread of people think 1 or 2 additional hikes. So you're close to the end of the cycle. That was an impression a belief as of September. It's not a promise or a plan of the future. And so we're going into these meetings one by one. We're looking at the data. As I mentioned, we're also, we're being careful. We're proceeding carefully because we can proceed carefully at this time. Monetary policy is restrictive. We see its effects, particularly in interest-sensitive spending and other channels. So that's how I think about it.
Neil.
Thanks. Hi, Chair Powell. Neil Irwin with Axios. In light of the run-up in long-term yields we've seen the last several weeks, have you given any consideration to the pace of your asset runoff program? And if there were a judgment that the higher term premium was endangering the dual mandate goals, would that be reason to think about slowing or suspending QT, or should we think of that as more of a technical question around reserves?
So committee is not considering changing the pace of balance sheet runoff. It's not something we're talking about or considering. And I know there are many candidate explanations for why rates have been going up, and QT is certainly on that list. It may be playing a relatively small effect, although I would say at $3.3 trillion in reserves, it's not. I think it's hard to make a case that reserves are even close to scarce at this point. So that's not something that we're looking at right now.
Victoria.
evaluate how those tighter financial conditions are hitting the economy and if it will lessen the need for further tightening? Also, do you think that those higher yields could affect banking stress?
So what do we look at? We look at a very wide range of financial conditions. And in fact, as you'll know, different organizations publish different financial conditions indexes, which can have 7 or 8 variables, or they can have 100 variables. So there's a very rich environment, and we tend to look at a few of them. I'm not going to give you the names, but there are a few of the common ones that people look at. And so they're looking at things like the level of the dollar, the level of equity prices, the level of rates, the credit spreads. Sometimes they're pulling in credit availability and things like that. So it isn't any one thing. We would never look at, for example, long-term Treasury rates in isolation, nor will we ignore them. But we would look at them as part of a broader picture. And they do play a role, of course, in many of the major standard financial condition indexes. Your second question was?
On the banking stress.
Banking stress. So it's something we're watching. As you know, we did have, there were issues with interest rate risk and also, funding uninsured deposits in the March, the things we went through in March and thereafter. And so we've been working a lot with financial institutions to make sure that they have good funding plans and that they have a plan for how to deal with the kind of portfolio unrealized losses that they have. We do think the banking system is quite resilient. We had a handful of bank failures, but so that's what we're out there doing, and we don't have any reason to think that these rate hikes are materially changing that picture, which is one of a strong banking system and one where there's a strong focus by banks and by supervisors on liquidity, on funding, and those sorts of things.
Scott.
Edward Lawrence with Fox Business. So over the last 3 months, the year-over-year PCE inflation was at 3.4%, core well over 3%. You've said in the past 2% remains the Federal Reserve target, but with no rate increase today, how long would you be okay then with a 3% or 3% plus overall inflation?
The progress is probably going to come in lumps and be bumpy, but we're making progress. I think the core PCE came down by almost 60 basis points in the third quarter. So the best thing I could point you to would be the September SEP, where the expectation was that inflation by the end of next year on a 12-month trailing basis would be well into the 2s, and the year after that further into the 2s. So that's if you look historically, that's sort of consistent with the way inflation comes down. It does take some time, and as you get further and further from those highs, it may actually take longer time. But the good news is we're making progress, and monetary policy is restrictive, and we feel like we're on a path to make more progress, and it's essential that we do.
Well, you've said in the past that doing too little on interest rates could take years to fix, but the cost of doing too much could be easily fixed. How robust was the debate about this pause on the doing too little side?
That's always the question we're asking ourselves, and we know that if we fail to restore price stability, the risk is that expectations of higher inflation get entrenched in the economy, and we know that that's really bad for people. Inflation will be both higher and more volatile. That's a prescription for misery, and so we're really committed to not letting that happen. For the first year or so of our tightening cycle, the risk was all on the side of not doing enough. We've come far enough that the risks have gotten more two-sided. You can't identify that with a lot of precision, but it does feel like the risks are more two-sided now. But we're committed to getting inflation back down to our target over time, and we will.
Simon.
Simon Rabinovich with The Economist. Quick follow-up to the question about banking stresses. You talked about how the banking system is resilient. Of course, part of the resilience of the past year stems from the Bank Term Funding Program that you launched in March. Given that bond prices have not recovered, that unrealized losses are probably mounting, how likely is it that you might have to extend that program in March next year?
Good question. We haven't really been thinking about that yet. It's November 1, and that's a decision we'll be making in the first quarter of next year.
Great. Sorry, quick separate question about inflation expectations. The Michigan Sentiment Survey showed a big jump in 1 year ahead inflation expectations last month from 3.2 to 4.2. Last year, you said that particular survey was a really decisive factor in one of your rate hike decisions. If it stays elevated next time around, how big of an input will that be into your December thinking?
Yeah, we look at a range of things. I think the thing got blown out of proportion a little bit. It was actually a preliminary estimate that got revised away, and I said it was preliminary in that, but that didn't get picked up. So we look at many things, and so really look across the broad array of surveys and also market-based estimates, and we do that really carefully at every meeting and between meetings. And it's just clear that inflation expectations are in a good place. The public does believe that inflation will get back down to 2% over time, and it will. They're right. So, and there's no real crack in that armor. You can always find one reading that is a little bit out of whack, but honestly, the bulk of them are just very clear that the public believes that inflation will come down, and that's, of course, we believe that's critical in winning the battle.
Hi, Chair Powell. Megan Casella with Barron's. Thanks for taking our questions. I wanted to see if you could talk about the neutral rate. You mentioned today that you're still debating whether rates are sufficiently restrictive, and you've recently said that evidence is suggesting policy is not too tight right now. So I was curious if you could elaborate on that at all and whether that means the neutral rate, in your view, has risen.
Yeah. So first thing to say is that it's very important. It's a very important variable in the way we think about monetary policy, but you can't identify it with any precision in real time, and we know that. So you have to just take that. You have to take your estimate of it with a grain of salt. What we know now is, within a range of estimates of the neutral rate, policy is restrictive, and it's therefore putting downward pressure on economic activity, hiring, and inflation. So we do talk about this. There's not any debate or attempt to sort of agree as a group on whether R-star has moved or not. Some people think it has. Some people haven't said that don't think it has. Ultimately, it's unknowable, and so really, again, what we're focused on is looking at the data and giving ourselves a little more time now to look carefully at the data by being careful in our moves. Does it feel like monetary policy is restrictive enough to bring inflation down to 2% over time? That's the question we're asking ourselves. I think years from now, economists will be revising their estimates of R-star as it existed on November 1, 2023. We can't really wait for that in making policy. We have to we have to have those models and look at them and think about them, but ultimately we've got to look at the effects that policy's having, accounting for the lags, which makes it difficult.
If I could follow up on a wages point earlier, you talked about the inflation outlook, but I'm curious if you have any concerns whether wage inflation at its current level could risk pushing up overall inflation or reacceleration.
So if you look at the broad range of wages, they have wage increases have really come down significantly over the course of the last 18 months to a level where they're substantially closer to that level that would be consistent with 2% inflation over time, making standard assumptions about productivity over time. So it's much closer than it was. And that's true of the ECI, which is the one that we got this week. It's true of average hourly earnings and compensation per hour too. So, and all of them are kind of saying that, which is great. And you have to look at a group of them because any one of them can be idiosyncratic in any given reading. So that's what you see. And so what you saw with the ECI reading was, if you look back it comes out 4 times a year. If you look back a couple of quarters, you'll see it was much higher, and then it came down substantially in June. And then the September reading was more or less at the same level as the June reading. So in a way, it's just validating that decline. And it was very close to our expectations internally, too. So I think we feel good about that. Also, I would say, it isn't, in my thinking, it's not the case that wages have been the principal driver of inflation so far. Although I do think it's fair to say that as we go forward, as monetary policy becomes more important relative to the supply side issues I talked about and the unwinding of the pandemic effects, it may be that the labor market becomes more important over time too.
Nancy.
Hi, Nancy Marshall-Genzer with Marketplace. Chair Powell, are you now as concerned about overshooting and raising interest rates too much as you are about getting inflation down to the 2% target?
So as I mentioned, I think for much of the last year and a half, the concern was not doing too much, not doing enough. It was not getting rates high enough in time to avoid having inflation expectations, higher inflation expectations become entrenched. So that was the concern. I think we've reached now more than 18 months into this. You can see by the fact that we have slowed down, although that we're still trying to gain confidence in what the appropriate stance is. But you can see that we think, and I think, that the risks are getting more balanced. I'll just say that they're getting more balanced. The risk of doing too much versus the risk of doing too little are getting more closer to balance, because policy is I think clearly restrictive at 5.25% to 5.5%. That range, if you take off a mainstream estimate of the expected inflation, take 1 year inflation, you're going to see a real policy rate that is well above mainstream estimates of a neutral policy rate. Now that's arithmetic. It doesn't really, what the proof is really in how the economy reacts. But I would say that we're in a place where those risks are getting closer to being in balance.
And you said the proof is how the economy reacts. What are you looking at to be sure you're not overshooting?
Well, I think what we're looking at is, is inflation still broadly cooling? Is it sort of validating the path we saw over the summer, where inflation was clearly cooling and coming down? Now, we've seen periods like that before, and there hasn't been follow through. The data have bounced back. So what are we seeing? Are we seeing, is inflation still coming down? So that's the first thing. Second thing is, in the labor market, what we've seen is a very positive rebalancing of supply and demand, partly through just much more supply coming online, and with labor demand still clearly remaining very strong. When you have the kind of job growth we've had over the last quarter, it's still very strong demand. So, and you see wage increases coming down, as we discussed, but coming down, in a kind of gradual way. I think we want to see that whole set of processes continue.
Brian.
Thank you. Brian Mena, CNN. Do you think that has been any structural change in either consumption or in the job market that's pushing up consumption? You obviously saw the third quarter GDP figures, which were strong, and some economists have expected revenge spending to have fizzled out by now. So I'm kind of wondering if there's been any structural change in consumption.
I wouldn't say there's been a structural change in consumption. I would say it's certainly been strong. And so a couple of things. We may have underestimated the balance sheet strength of households and small businesses, and that may be part of it. There may be, we've been, like everyone else, trying to estimate the amount of savings that households have from the pandemic when they couldn't spend on services really at all, or in-person services. And, there can still be more of that than we think, although at a certain point we're going to be getting back to pre-pandemic levels of savings. We may not be there yet. So clearly people are still spending. The dynamic has been really strong job creation, with now wages that are higher than inflation in the aggregate anyway. And that raises real disposable income, and that raises spending, which continues to drive more hiring. And so you've had that whole dynamic has been, and also at the same time, the pandemic effects are wearing off so that goods availability, automobile availability is better or was better. I think it still is. And from a business standpoint, there are more people to hire, and there's more labor supply. So the whole thing has led to more growth, more spending, and that kind of thing. And it's been good. And the thing is, we've been achieving progress on inflation in the middle of this. So it's been a dynamic. The question is, how long can that continue? And I just think the existence of this second set of factors at this time, which is the unwinding of the pandemic effects, that's what makes this cycle unique, I think. And we're still learning. Took longer for that process to begin than we thought, and we're still learning about how it plays out. That's all we can do.
So to Daniel for the last question.
Thank you, Chair Powell. Daniel Avis from Agence France Presse. Just a quick question following up on an earlier one. With regards to the Israel-Hamas conflict, the Fed's financial stability report said that Israel-Hamas conflict and the conflict in Ukraine pose important risks to global economic activity, including the possibility of sustained disruptions to regional trade in food, energy, and other commodities. You've had organizations like the World Bank warning of a possible surge in oil prices if the war spreads to other countries in the region. I'm just wondering how the Fed is monitoring these developments in the Middle East. You mentioned they are, and just what the potential economic impact could be if the conflict does spread to other countries in the region. Thank you.
I wouldn't want to speculate too much, but I'll just say, so, really the question there is, does the war spread more widely, and does it start to do things like affect oil prices in particular, since this is the Middle East we're talking about? The price of oil has really not reacted very much so far to this. As the Fed, as the Federal Open Market Committee, our job is really to understand the economy and the economic effects. And it isn't clear at this point that the conflict in the Middle East is on track to have significant economic effects. That doesn't mean it isn't incredibly important and something for people to take really important notice of, but it may or may not turn out to be something that matters for the Federal Open Market Committee as an economic body. But what the Financial Stability Report does is it calls out risks, and that's what it's doing, is calling out a risk of that. And the war in Ukraine, the same. War in Ukraine, did have immediately very significant macroeconomic implications because of the connection to commodities. So, thank you.
Thank you.
Thanks very much.
Part of the market are getting knocked around by that as well. But small caps, it doesn't matter to how many charts I can show people suggesting that the balance sheets are not that bad. People simply don't want to hear it. And there's a view that small caps are simply not going to be able to weather the storm that's created by the surge in interest rates, whether it's 10-year yields or Fed funds. And again, I have so many charts, Lisa, that I've been showing people for the last 6 months saying, hey, small caps have done a good job of shifting towards long-term debt. The variable rate's down. The weighted average maturities are really not that bad, on average about 4.5 years. People simply don't want to hear it, Lisa. There's just been a long adage that small caps don't weather higher interest rates very well. And I think that's one of the big reasons why they're getting punished right now.
Lori, can you talk about sector performance within the small cap sectors? Because I do think that the sectors are telling an interesting tale in small caps that maybe we're not picking up in large caps.
So if you think about, think about it from a valuation perspective, I will say that most sectors in small cap look cheap relative to their large cap counterparts. But where it gets really interesting is on some of the cyclical sectors. So it's not just small cap financials that are dragging down the Russell 2000 from a valuation perspective. Healthy sectors from a fundamental perspective, like industrials, also look pretty cheap relative to large cap in the small cap space. Consumer discretionary stocks really look kind of left for dead. If you look at valuations there, they're deeply, deeply cheap, and they were actually really down around recession-type lows last summer. So we're really seeing that pain very, very widespread.
And given we are in the midst of earnings season, is there anything that you're getting out of earnings that maybe is not getting picked up by the markets, considering the markets are so captivated by what's happening in these macro indicators?
So I think people are really misunderstanding what's going on with inflation moderating and what that does to companies. One of the things that we've seen when we compare our numbers versus the street consensus, and we actually, we use the Bloomberg data to monitor the street consensus, and it does a really good job of articulating how margin expansion is baked into a number of different sectors next year. Well, in my modeling, we actually don't have margin expansion. We kind of have margins going back to 2022 type levels. And one of the reasons why is that we don't give margins a big benefit from sliding inflation. We simply haven't seen a justification to do that in our back test. And when you go through all the transcripts, what we're really noticing is that companies are picking up on this. So the pricing discussion has simply gotten much, much squishier, and companies are saying it's going to be a softer pricing environment. Of course, there are a couple that are out there saying they're going to raise prices to infinity and beyond. That's not really the norm here. And what we're really seeing is that companies are acknowledging that they're not going to have an excuse to push these prices through as the cost environment moderates. And so we're not, going to necessarily see this big boon to margin expansion simply from costs coming down and prices staying high. And I think that's really what's embedded in a lot of street assumptions for next year.
Lori, I'd like to build on what Gina was referring to about sectors, and specifically sector dispersion amongst large cap names, right? I mean, it's usually at its highest during periods of distress. I'm thinking 2000, 2008, yet sector dispersion has been very high since the pandemic started. I mean, I wonder what you take from that. I mean, certainly we look at some of the interest rate sensitive sectors and how they've underperformed. I mean, is that going to continue? I mean, what's it going to take to kind of get these correlations to right way?
So I'll tell you, Damian, what I feel like I've noticed in the sector data over the last couple months, and this is looking at the S&P 500 specifically, but it feels like anytime there's a part of the market that gets a little bit of leadership, it can't sustain it for that long. And I've described it as, sort of this sniper that goes out. Anything good we have just gets taken away. And we saw, utilities, for example, was having a really nice moment late in the summer, and then all of a sudden just the bottom fell out. Yeah. We've also seen energy just really kind of lose that luster. And I think the problem is that the market is losing confidence in any one narrative. We really can't get a rotation going because on the one hand, tech stocks look expensive, they look crowded, their earnings dominance is starting to fade, and hey, interest rates are not usually a good thing for those stocks, so that's starting to take a toll. But anything the market wants to rotate into just can't seem to maintain its footing for all that long from a fundamental perspective either. So it's just been a real struggle, I think, both to find something to generate incremental excitement in the market and to really allow that rotation to play out.
Well, Lori, I'm so happy you mentioned utilities, because it's been utilities and consumer staples, those traditionally low beta defensive sectors that have underperformed. I'm wondering, how do you position defensively in today's market?
So I think it's very tough. I've actually got an underweight on consumer staples. I'm neutral on utilities. I'm overweight healthcare. That one's had a tough time getting going as well. But to me, it's got the nicest combination of decent valuations. At least until recently, it's had strong earnings revision trends. We've seen the med tech space sort of take a little bit of a hit, and there's been a concern about the weight loss drugs that emerged. I've been trying to tell people that happened at a time when the med tech stocks looked like they were kind of over their skis from an earnings revision perspective anyway. But if you look in other areas like pharma biotech, if you look at the providers and services space, you have a really nice kind of ramp up in earnings revision trends that feels like it has more room to run. It's not a perfect story by any stretch, but other than the weight loss drugs, it does feel like it has less macro hair than, say, utilities and staples. With staples, I will tell you my analyst is starting to feel a little bit better there, just based on the fact that we did have this big sell-off from the weight loss drugs. And valuations, I will admit to you, are pretty compelling, but I do continue to worry about that sector from just a pricing perspective. I think it's right at the sort of center of the storm I mentioned in terms of not being able to pass through higher prices for much longer. We're seeing those companies actually really talk about how consumers are pushing back.
Lori, what does it tell you that you can have the right idea in terms of the solidness of a corporate balance sheet, that you can have the right idea about historical valuation, and that investors just won't bite, that it doesn't actually work in trading practice?
I think it tells you that, whether it's the Middle East, whether it's interest rates, we're in a sentiment-driven market at this point in time, and confidence is just very, very fragile. One of the things we've talked about, Lisa, a lot this year is how 2022, 2023 has felt a lot like 2010, 2011, and 2002, 2003, which were kind of messy, extended post-crisis normalization periods. I lived through both of those as a strategist, and what we saw was that confidence was just very fragile. There was a constant fear of the next skeleton coming out of the closet and blowing things up. Constant fear of tipping into another economic downturn. And I think that's the environment we've been in recently. And so anytime time we have issues that come up, there's just not a lot of confidence that either companies or management teams or the market as a whole or the economy is going to be able to weather the storm. And that kind of felt like it was easing over the summer, but I feel like we're getting sucked right back into that messy normalization period again where confidence is low.
Lori Calvasino of RBC Capital Markets, thank you so much for being with us. Would you agree with that, Gina, that basically that seems to be the sort of sentiment messiness that's actually a recovery, not the opposite?
Yeah, I do think that that's pretty consequential or pretty consistent with what we see right after recession experiences, with the one exception that inflation conditions have been so profound in this cycle, where we didn't really have to worry about a reacceleration in inflation. We didn't have to worry about inflation's impact on earnings in either of the post-recession recoveries of the last two cycles. That's been characteristically pretty important, and that's what, in my opinion, is driving that sector dispersion that Damien mentioned. Is just this inflation story is creating really different sector-level outcomes, which is creating different outcomes for the market at large.
Well, Gina, I think it's the leverage factor, and you've written to this previously, right? The reason those defensive sectors are performing so badly is because they have high leverage.
Yeah, it makes a huge difference with rates moving as they are, and I think rates are moving because of inflation.
It's complicated. Maybe
we all know that. Sure, today was a day where we measured what the Fed's done for us lately, as Fed Chief Jay Powell spoke about interest rates, keeping them the same, talking about the need to proceed carefully. Powell's assurances that he can get inflation under control, even though it's still running a little too hot, certainly made us feel a little more sanguine about stocks. That's one reason why the Dow gained 222 points. S&P jumped 1.05%. The NASDAQ, holy cow, it pole vaulted 1.64%. But there was another reason for today's rally. It was from the Treasury Department, which published a bond issuance schedule for November. These are the bonds we need to issue to refinance our country's debt for next year, and this schedule was exactly what we needed to see because it caused long-term interest rates to fall. Put it simply, the bond market won't be overwhelmed by so-called long bonds, meaning 20 and 30-year paper. And that's another positive, something that allows Wall Street to reward good corporate news with higher stock prices.
How's pleasure? After all, rates have gotten very tight, correct, as Powell acknowledged? So we're seeing some slowing in many areas of the economy, making earnings more perilous. Season's been tough. Of course, rates still might not be high enough. Powell said the Open Market Committee discussed more rate hikes, not standing pat. But for the moment, they left things alone. And they sound a lot less eager to tighten than they did the last meeting. You know what that means, don't you? It puts the few industrials companies that are still generating good numbers at a real premium. And it gives us the confidence to buy the stocks of companies that just reported great numbers. Buy. The problem, as I see it, is that we haven't really pointed out which companies have truly distinguished themselves during this earnings season because we've been so focused on the market's wild day-to-day gyrations. That stops right now, right here. Tonight, I'm going to tell you who did what for us lately and what happened when they did. I want to start with today's hero, or perhaps I should say heroine, and that's AMD CEO Lisa Su, who saved the day for her stock and for all of tech with one simple line in last night's conference call. Listen to this, and I quote, "Based on the rapid progress we are making with our AI roadmap execution and purchase commitments from cloud customers, we now expect data center GPU revenue to be approximately $400 million in the fourth quarter and exceed $2 billion in 2024 as revenue ramps throughout the year," end quote. Parsing that line, Dr. Su is saying that AMD's revenues from graphics processors used in the data center about to soar thanks to artificial intelligence. These are the kind of chips that people normally associate with NVIDIA, and as they come online, it's going to produce bountiful sales for AMD. I've always said that this company is the only company that has a chance of becoming a meaningful competitor in AI chips. And it's clear that business is strong enough that there's plenty of money to go around for both NVIDIA and AMD. Sue's talking about real revenues this year, not some chimerical sales in 2027. It's what they've done for you lately, hence the stock's almost 10% rally today. With that one line, Lisa Su jump-started the moribund AI group, pushing up the stocks of NVIDIA, which have been trading like it was on death's door, along with Microsoft, ServiceNow, Amazon, and Adobe, the only companies that have actual acknowledged revenue from AI right now, at least so far. Hey, then there's Trane Technologies. TT, you've seen them on the show. Used to be mainly as heating, ventilation, air conditioning business, but it's now a sustainability solutions enterprise. Trane had incredibly robust bookings with organic revenue growth of 9% and earnings per share up 23% year over year. Their legacy HVAC business is, and I quote, extremely strong, and applied climate technology is on fire, bolstered by government regulations. That's an always good tailwind to have. That's how the stock can jump 12% single session. Or how about Eaton? Wow, old-fashioned metal bender, huh? No, shrewd pivot to become the leader in a host of megatrends, including electrification, energy transition, digitalization, infrastructure spending, and reindustrialization. You know what? I'm calling that the royal flush of American business teams, and Eaton dominates them all. On the conference call, Eaton explained that it's expanding data center build-out, some of which, and I got a quote here, are being modified to support the adoption of generative AI. Holy cow! Anything that generates electricity in a relatively clean way seems to have Eaton's fingerprints on it. It's all captured by this sentence from the conference call. Another trend driving higher electric content is the need for solutions that allow bi-directional flow of power back to the grid and the ability to optimize the use of renewable energy to power data centers.
Boom shakalaka. I mean, that's what we did, right? Hey, that's how stock rallies 3.3%, but the best in show anyway. I think you'd still buy it. Those are all the saviors of the last 24 hours, and I can't say enough good things about them. You know what? They joined the likes of Linde, a growth cyclical industrial gas company, which has become one of the most reliable beat and raise enterprises in the universe, owned by the Travel Trust. Street calls Linde a, quote, sleep at night stock because of its endless margin improvement, consistent cash generation, and great cash deployment. Barclays even described it as a stock that allows you to hit, and I quote, the snooze button. Oh, I wish we had more snooze buttons. Same goes for General Electric, which last week showed that it had some of the best numbers I can recall because of a terrific aerospace business. And with, and I quote, orders up double digits with services up 15%, equipment up 22%, and growth in all segments, end quote. GE stock got dinged today because of some offshore wind project cancellations. Hey, my home state of New Jersey, not good for its coming power spinoff, but it's giving you an opportunity to buy this high-quality industrial at a much better price. Of course, as much as I salute these stocks, they've been running here, and regular viewers know that I hate to chase. So therefore, you might want to ask who's at the cusp of a turn in business whose stock is way down, a positive turn, even as their stocks right now are shunned. Who's the next AMD? Who's the next trade? Let me tell you about two of the stocks we own from Travel Trust because they're way down, and I think they could be primed to get better. You sure ain't paying top dollar. We're going to start with DuPont. Yeah, double D, the old-fashioned chemical company that reported what was widely panned as a disappointing quarter today. Yet if you speak to the ever-bankable CEO, Ed Breen, he said that he's finally seeing some green shoots in the electronics end markets that are a major driver of DuPont's earnings. Normally, I'd say that you can just forget about this one, another screwed-up one. But Ed told me that he suspects a turn could be at hand. And Ed's been, he's been around the block. I trust him. I trust DuPont. I could be wrong. I'm wrong about stocks. I know that. But I like this one. Second, there's a stock that the Trust bought today, and boy, is it ever down. And now it's called Oracle. And so if it's the AMD pattern, if you recall, when Oracle reported, CEO Safra Catz and founder Larry Ellison talked about how their data center cloud AI business is on fire. Well, I can buy into that down here. The stock's 22 points from its high. 19 times earnings. Not too shabby, not too risky. Now remember, this exercise of rewarding the companies that beat the numbers has only been working inconsistently of late. Because we've been so darn worried about interest rates. When long rates soar, nobody cares about the earnings I just mentioned. But we had no worries today. Because the Fed just spoke and Treasury rolled out a jolly benign bond issuance schedule. More on that in a moment. Bottom line, these two positives make the what have you done for me lately equation a game worth playing. Because suddenly the market actually cares about the results of individual companies. Given that the Fed and Treasury won't be able to do a 180 anytime soon, and we still have an oversold market, we could have more moments just like this one. Hey,
and your insight in the stock market, I wanted to get your perspective on FedEx. Could you share your insights?
I'll give you my perspective on FedEx. It is run by one dynamite CEO. I think the world of this company, Raj Subramanian, is going to be able to handle this downturn at $243. I'm saying it is a buy. Travis in Kansas. Wow, Kansas City. That's Travis Kelce, right? Tell him I want to try. Just put the girlfriend on.
Hey,
hey, how you doing?
Let's hear about,
is this Mr. Pfizer?
The Netflix.
I thought it was Mr. Pfizer. All right, now which one? Which stock?
Netflix movies.
I like Netflix. They just wore a dynamite quarter. They got good ad-driven stuff coming. I think that it is high quality. And by the way, just so we know, it kind of had already had the dip, and now it's got the pause and refresh. You can buy Netflix. We're going to go to Will in Kentucky. Will.
Hey, Jim, this is Will in Lexington. Hey, I had a question about Palo Alto Networks. I'll be honest, I've kind of trimmed a lot of my individual positions. Of course, I still got some ETFs, but I like Palo Alto because it's got cash flow, and I like the story. I mean, it doesn't seem like we're going to be in a safer world.
All right, listen to me, Will. Will from Lexington. I happen to like the town of Lexington very much. I've been to that horse park there. It's dynamite. Here's what I know about Palo Alto. I'm calling it best in show when it comes to cyber. The fact that it's at 244, still down, it's down 21 points from its high. You're dealing with Nikesh Arora. Whenever you hear about these cyber attacks, whenever you hear about what North Korea's up to or what Iran, you should be thinking, I got to buy something. P-A-N-W. And that's why Will has horse sense. Given that the Fed and the Treasury won't do 180 anytime soon, as they just spoke today, we still have an oversold market. We can have more moments like today. I think this is a bona fide good one. Mad Money tonight. On this
channel. So I don't think we're necessarily going to break. And there you go, Johnny on the spot. But I just think this is sort of a continuation of an uptrend that's been in place since May.
Yeah, Carter's charts, yesterday suggesting, maybe you have another 20 basis points or something like that. And your reverse charting in the TLT said, well, maybe get that up to the high 80s. And that all made sense to me. If you're just looking at this really simple chart of the 10-year yield, I mean, if it were to go back and touch that trend line, 4.5%, from 5, down from 5, the question is, let's throw up the S&P chart. Where would the S&P be? And, this is a conversation that, Karen and I have been having on the set of Fast Money over the last.
But to your point, the conversation you're having with Karen, at some point, something's going to give, right? This I guess, relationship is not going to last forever. Something's going to break. And if we do, in fact, I think, get through that 4.5 level in yields, which I don't think is going to happen, by the way, I'm not completely sure that that's going to be supportive of equities.
Yeah, well, let's bring Carter Braxtonworth in if we're charting here, because maybe he can help us think about this a little bit.
It'll only help.
Carter, how are you, bud?
Right, sorry. Hi. Someone said, I think you look as though you just got off a motorcycle.
That's great.
I'm good.
I'm good. Trying to figure it out as you are, and there are always nuances and inputs and data points that both confirm and contradict one's opinion.
help me with this, okay? So we've been going back and forth with this on Fast Money for the last week. And again, your work has suggested, I've seen it in worth charting, you know what I mean? You don't exactly want to be buying equities at the point in which the Fed is going to start lowering interest rates, right? I mean, because again, going back to what Guy just said, what's the reason for them lowering interest rates? If they did such a magnificent job on the way up, right? Like, and they're able to lower them on the way down, then that is what we would call, nailing the landing. But that's what the debate, that's what the volatility in the stock market has been about since they started raising interest rates in March of 2022. So my question to you, Carter, if you go back and look, the last 4 major rate increase periods, okay, we'd have to go back to over the last 18 months, okay, we know what happened there. If you go back to 2017 and 18, when Jerome Powell came in as the Fed chair and he started raising interest rates, we saw in Q4 of 2018, the stock market at the first hint of a growth scare globally sold off 20%. Go back to 2007, the Fed had been raising rates, right, since the dot-com implosion, since the long protracted bear market and recession that we had, right, and we had in 2007. If you started buying stocks, right, when the Fed started lowering interest rates, that was a painful sort of thing. And then obviously going back to 99, 2000, the same thing. Karen has mentioned 1994. I said, fine, you can have 1994. I'm going to take 2000. I'm going to take 07. I'm going to take 2018. You know what I mean? And I'm going to take this most recent period. So talk to me, like, how do you make sense of that?
Yeah, well, 94, right? The start of the year, January through March, was quite flat. They doubled Fed funds from 3 to 6%, and the market froze up. It was one of the tightest ranges ever recorded on a 6-10-month basis because the market was trying to digest this. And then obviously it took off in the back half of 94, and basically we went all the way to the 99 high. But that initial tightening, right, sort of froze things. But I think the biggest thing of all is, of course, to watch the 2-10 spread. And as that spread keeps narrowing, that is quite often a precursor to trouble in the general equity market.
And that's what we're seeing now without question. I mean, we've gone from 105 basis points. I mean, where we get down to about 15 or so basis points, and I'd have to look right now in real time. But yeah, and that's something Elizabeth Young mentions as well. So look, we'll see how it plays itself out. I think people are sort of getting bolstered by the fact that maybe Treasury is slowing things down in terms of debt offerings. I think a lot of these things are somewhat short-lived. I don't think it changes any of the fundamentals. But something's changed, Carter, over the last couple of weeks in the energy market. And you brought with you a bevy of charts to illustrate exactly that. So let's walk through your energy thesis.
These are charts from about a week ago, not quite, but it's from a report for clients and online worth charting subscribers. And what we were trying to show is the importance of certain levels. The first thing that stands out is we never could make the high, right? So that we had this incredible move from the COVID low to present, which itself is in response to the preceding collapse, right? Energy stocks collapse, no boats moving, no cars moving, no planes moving. COVID makes shocking lows, and then this epic recovery from essentially 200 to 700. But 1, we couldn't make a new high. 2, we're flirting with breaking trend. And actually, since this note went out, right on, we have broken trend. Let's look at the next way to draw the lines. I mean, again, that's a bit of a sort of subjective double top because 1 is a fairly precise period of time and 1 is a year's worth of trading. But that's what my eye sees, and I think the burden of proof has shifted to the bull, meaning the bull just had to say, take a look at the facts. Energy is an outperformer, but not anymore, right? This is under pressure. I don't. What other? We might have a few more iterations.
We have crude oil charts as well that you brought.
So we've got the XLE, and this is the actual ETF, of course, that you can trade, which has 100% correlation with the preceding charts, the S&P 500 GICS energy sector. And so the question is, do we or don't we breach this uptrend line? And we went slightly below it. You've got the triple top, which is a formation that's well known. So you couldn't break out, you tried again, and then ultimately you roll over. If we wanted to look at crude, and we can, trend lines are subjective, right? Just as price to book and enterprise value, EBITDA, and price targets. But if you were to take this trend line, simply connecting the June low with the August low, we broke trend. Let's say we were a little more generous. Let's look at the next. Let's toggle those two. So that's the severe trend line we clearly broke. That's a little less severe. We're being more generous. Let's be even yet more generous and say, but you can't keep doing that. At one point, the line's going to be lying on the ground, right? It's not a trend line anymore. And we are starting to breach this line even now since the report was published. So I think we might have one other, and there it is. So we're into support, and it's finding support, but it's not really bouncing. And so I would say it's a pair of 2s with a bias to the downside.
Carter, before we go on, let's go back to that XLE chart because it must have been now, I don't know, 3 weeks or so ago where I actually looked at this and said, there's no way we're going to have a triple top in the XLE. It just doesn't happen. And I thought, given the move we were seeing in energy and some of the other things, some of the underlying equities, and then obviously we saw the Exxon deal. We talked about the Chevron deal. I'm like, right, these things are going to be off to the races. Obviously, it didn't take place. How rare is it to have a formation like this? Or is this just sort of run-of-the-mill type of stuff?
Run-of-the-mill, because it doesn't have to be that it's triple. It's the concept is that it had a great and steep advance running up into late 21, early 22. And basically, it's never been able to keep that momentum going, right? So you keep attempting to keep the sequence going, keep making a new high, and it hasn't. And every time you try, you expend a little more energy, you sort of run out of oomph, if that's the word, and I think it is. And so does it mean it has to break trend, the reciprocal or correlative? No, but that's the burden, right? And even this, if it just continued sideways, it would break trend because it would start to go below the line, right? There's that circumstance as well.
Yeah, it's interesting, Guy, and I remember you and I talking about it at the time when the XLE was kind of approaching, that prior high, right? And again, like, your view on the fundamentals of the companies. We know that, Exxon and Chevron make up 40% of the weight of this ETF here. And when you just consider the two transactions that have been proposed, right? So it's Exxon, I think it was about a month ago or maybe 3 weeks ago, proposing a $60 billion deal, and Chevron proposing a $53 billion deal. When you talk about ringing the bell, I mean, like literally, doesn't this have to be in, go down, as like the mother of all bell ringings for the sector? Now, you can look at it in two different ways. The only way that I'm going to look at it right now, given the poor price performance and given the relative performance that Carter's talking about here, Guy, and I'd love to get your take on this, is that, okay, like to me, I feel like they are going to be mired now in regulatory BS for at least a year until we get through the election result a year from now. Do you know what I'm saying? And that might really put a damper, at least an investor enthusiasm for these stocks. Does that make some sense? And so to Carter's point, if the XLE just goes sideways, then that means it's technically breaking down. Right? And so I don't know. I'm just curious your thoughts here.
No, look,
has your view changed a little bit?
No, my view hasn't changed. I mean, obviously the technicals should suggest that it should change, but in terms of ringing the bell, I mean, it happened last year, same time last year when Chevron announced at the time a $75 billion stock buyback. And if you recall, I don't know if we can look at a Chevron chart and go back to basically a year and a half ago. When Chevron announced, I think it was the fall of 2022, stock was making an all-time high. That was a bell ring of epic proportions. And if we look at it, well, you can see it, but if we even zoom out a little bit so you can see the context of the move it had into that fall, I mean, you see a stock so you see a stock that was off to the races. They announced that stock buyback. That was it. I mean, basically, we took another run early in 2023, but we've never seen those levels since. And listen, just making a good point. You could be the same thing again a year later in terms of not so much a stock buyback, but these suggested M&A deals. We'll see. I will tell you, though, if we can pull up a gold chart real quick and then go back and look at that XLE triple top, the gold chart looks exactly, and I don't know if it's coincidental or not, but exactly like that XLE chart. So just vision that sort of XLE chart that Carter just drew, and then look at the gold chart, and it's like, oh my God, this is hauntingly familiar, CBW.
Yeah, I mean, one thing to put your time at ringing a bell is that the premium was so low, right? If you look at where Hess was trading, and then after the reaction, or you look at Pioneer, I mean, basically, if these things were such great assets, why weren't they taken out 30% higher, 40% higher? They're taken out single digits. And so it does suggest that there's a cap. I mean, strangely, look, energy, big oil, as it used to be referred, there's that famous book, The Prize, right? It's such an important thing. I mean, literally, it is the thing that moves the world, and yet it's only 4% of the S&P. That's the irony of the whole thing. It's millions of jobs and lots of geopolitics and wars, and yet the whole thing adds up to nothing in terms of the value of publicly traded equities in the United States.
All right, let's hit a couple single names before you get out of here, Carter. Tomorrow's going to be a big earnings day. Starbucks before the opening, and then Apple after the close. And Starbucks is interesting to me, just the way that maybe some of these other consumer discretionary names have acted of late. This one has not been trading particularly well. The implied move in the options market is about 5.5%. Thoughts here on the relative underperformance that we've seen here. This stock, we mentioned on many occasions. When this was supposedly a rip-roaring bull market for the better part of this year, this stock did not act particularly well. Nike did not act particularly well. These are names that have always enjoyed a nice premium to their peers and to the market, and that premium appeared to be coming out most of this year. Thoughts on the technical setup in Starbucks into the print?
Yeah, I mean, here's the thing. The restaurant stocks in general, McDonald's is under a lot of pressure, right? DRI and so forth. It's just a heavy group. It speaks to the consumer, which has obviously been struggling in terms of the stocks from Target to Gap and so forth. I think it breaks trend here. This is a very short-term chart, but the relative performance is poor. This is an absolute chart. Look at the longer term. And this is some going back to the 09 low. We've breached that uptrend now. And you can draw lines a different way. Take a look at this next iteration. You can toggle those. I mean, those are very precise lines. This is a great annoyance to the CFA Society. They go, what in the hell? There's no valuation. Hit these lines. It's damn right it does. And so the question is it breaking down? This is one of these Peter Lynch ones, where every time I'm in a Starbucks, I wait a long time. The thing's constantly pumping out coffee and donuts, and it always looks full, and what a business. And of course, we'd all bought it at the 09 low at $4. Wouldn't that be a handsome thing? But what? Right now, as patterns go, it's not great.
Now, if you look at Starbucks, since I want to say May, Carter, and this has held pretty much serve, the stock was trading, I want to say 115. It's been a series of lower highs, and you can see that, and it's been a series of lower lows. Now, in order for that to continue, we probably need a close below sort of 88.5, 89, but, it's every indication that's going to happen. Now, obviously, we've seen stranger things before. I think Nike surprised a lot of people to the upside, but, valuation in this environment in Starbucks is not cheap. And I think this trend of lower highs and lower lows continues, Dan.
Yeah, it's interesting. If you just look at the options market, and again, we talked about an implied move that's about 6% in either direction. Maybe you want to look out a couple weeks or so. The November 91 puts that cost about $3.20. You can do the math on the percent of the underlying stock to get that sort of exposure. But if you buy, let's say $3 for the 91, your break even's down there at 88. And if you look at that, let's put up that 52-week chart. Again, if it breaks, this $90 level and it breaks that uptrend, that has been in place. I mean, you're likely going back to, I have to assume, to Guy, your point, mid to low 80s there. So again, thinking about how to express, views in the options market market using defined risk. That's not a cheap way to play, though, people. You know what I mean? Like, you can't just be littering the field with a bunch of 3% short-dated, potentially binary sort of bets, but we just highlighted just to show you one way in which to do that. Let's take a look at Apple here, because this is not too different, Carter. I mean, like, it has not acted particularly well. We know it's been a very popular name. I think you could make the same Peter Lynch argument about the Apple stores and what everyone's got in their hand and what everyone's got in their tote bags and everything like that. But this one has, I feel like the bloom is off the rose a little bit. Guy, you and I, and Carter, you know this from being on CNBC. There was a time, man, if you uttered a negative word about this stock, the vitriol that would come at you. I feel like much less so. I think Tesla and NVIDIA have actually taken that crown here. But talk to us a little bit about what you're seeing in the charts. And then, Guy, you've always had a much more nuanced, I think, view towards Apple than me, because sometimes I just kind of get stuck in the mud here a little bit. So I'd love to get your take. But Carter, what are you seeing in the charts?
Yeah, I mean, at least as I've annotated it here, you have that breakout that failed, right? So a bull trap, if you want to characterize it that way. Another way to draw the lines would to, and you'll see it here, is that and you can toggle those. I mean, basically, we break out and fail, and now we're sitting here at a critical juncture. And you could say it's coin toss, it's 50-50, and that's fair. Then you have to pick your direction or not play. Say, I don't want to play, it's too much 45, 55, 55, 45, or I do want to make a bet. If making a bet, my bet is down. And if we look at the longer term chart, and this is all data, put in some lines, and what's at risk here? Look at this. I mean, breaking this trend line is a pretty sort of telling and important thing. We shall see. Let's put in some arrows more just to how it's to the penny, to the penny, to the penny, working into the apex, the wedge, the stand. And so does it have to do what my red arrow suggests? No. But for those who are going to bet, I would be betting down.
It's interesting. We put on in the Instagram, by the way, we do have an Instagram account, and we showed Apple on one side, $2.7 trillion company. And then for just comparison purposes, we showed 6 companies that everybody has heard of out there, regardless of whether or not you're in the stock market. And we showed that you combine those companies, and guess what? It's $2.7 trillion. So if we look at the chart, if you're saying to yourself, Apple's a $4 trillion company over the next couple of years, quite frankly, it doesn't matter if you want to buy it here. I mean, you're buying it here, and $5, $10 doesn't matter. That's number one. Number two, if you go back and look, and we've talked about this, Apple does trade lower, at least a half a dozen times over the last 5 or 6 years. We've seen 30 to 45% peak to trough declines. We're seemingly in the midst of one now. I look at that shorter term chart, Dan, and I go back to the lows that we saw earlier this year. I want to say it had like a 120-ish handle. Maybe it was 123. That recent high that we saw, obviously, in June and July with everything else. And a 50% retracement of this brings us right to about $1.60. And that's a level we've been flagging for quite some time. And quite frankly, that lines up exactly with the type of peak to trough declines we've seen over the last decade or so. So it's not that I'm a hater. I don't really care one way or another about Apple. But what I will tell you is, regardless of what people say, Apple does go down. And as you've mentioned a number of times, Dan, the last 3 quarters have been, you're starting to see declines. Margins have seemingly, I don't want to say contracting necessarily, but they clearly have not accelerated. And this is a single-digit EPS growth and revenue growth company that trades close to 28 times next year's numbers. Something's got to give.
Well, that's it in a nutshell. The way I think about it is, okay, where is a lot of enthusiasm about this stock? It's about their access to a Chinese consumer, which I think, at least if we're going to kind of extrapolate from what we heard from Tesla about demand for their products, in September and in Q3, I think it's probably, they're both very aspirational products. You could say that they're very, very different price points used for very different reasons. But if there are some nationalistic tones that are kind of building up among consumers there, and then from a manufacturing standpoint, they're moving a bunch of manufacturing offshore. To me, I feel like there's going to be only headwinds as it relates to China with Apple, and that's a big part of that 27 times this future, earnings expectation, in my opinion. Like, that's one of the reasons why this stock gets that premium. So, I'm not particularly enamored with it. The one thing I will say is that down 15% from those recent highs, it has a setup not too dissimilar to Amazon in a way, where sentiment could not be worse, in my opinion, right now. Okay, it could be worse. If they miss and guide down, it's going to be a lot worse. Which brings me back to the options market. Okay, with the stock trading at about 172.5, the at the money, the 172.5 weekly put would cost you $3.50. That's 2% of the stock price. So if you thought that this company was going to miss, and then the guidance or whatever they give for guidance was going to be worse than expected, and it's going to be headed back to 160. I say to myself, that's kind of a cheap way to play. I mean, the options actually look cheap on a directional basis right here. And Guy, you mentioned 160, which would basically be a 20% peak to trough decline from that recent high. 150 is kind of that breakout level from the spring or so. I mean, that would make sense. And if there was ever a stock that is crowded, and if there was a narrative change where a lot of people would head for the door at the same time, and it wouldn't be a one-day event, it would be Apple. So again, let's take a closer look tomorrow. Carter's not going to be with us tomorrow. We wanted to get his take on the charts here. But again, I think we have a lot of different thoughts about what is playing into investor sentiment into this print. Let's see how the market reacts to what the Fed has to say. Let's see where the money flows. Okay, again, you know what I mean? After that event, let's see where rates are, because whether you believe it or not, one-day price action in the broad market, right, could actually have a pretty decent impact on how a stock like this might react. Because as you've said, Guy, this is an asset class in and of itself. I think the market cap is greater than all of the Russell 2000s. So.
It is its own asset class. I mean, $2.7 trillion. It's, as I've said a number of times, I'd have to look now. I think there are 317 or so ETFs that have Apple as a top 1, 5, 15 holding. So, in the world of passive investing, as money flows in, Apple goes up regardless of what's going on around it. It's only obviously events that for whatever reason take it down. So in the absence of news, Apple goes higher. It's just that simple. We're going to have news and we'll see. And by the way, we actually had a guest on last night, and I flat out asked him about the risk of about China and Apple. And he said, I'm paraphrasing, but he said the market's really not taking it into proper consideration. I agree with that, Dan.
All right, listen, Carter Braxton Worth, 2 days in a row. You guys know
right. How fun. And this is it. Apple is the big one, right? Most widely owned and sort of in the ethos of the world. It is the preeminent commercial enterprise in the globe.
Well, we can't wait to be on the set of Fast Money when those numbers come out. So we appreciate you being here with us, Carter Braxton Worth. You guys know where to find him, worthcharting.com. Nothing slick, just charts. Guy, what do you call it? You have your own tag.
Well, I do, and I know Carter, he makes a face when I say this, but I say it's no emojis, no hearts, just charts.
All right. CBW, thanks, brother. Go check out Worth Charting here, people. Guy, you
That's
just
catchy as hell. Can I tell you, that is catchy as hell.
It is catchy. You just mentioned your big Insta account. I think that the guy is back on Instagram. He's guy.adami. Go check it out. We are getting our Instagram accounts fired up. I am Dan S. Nathan. And when we have Risk Reversal Media, and we have our team really pumping out some really interesting content. They're taking some of our clips, but they're also kind of putting stuff visually. There's some videos there. They call them Reels, Guy. Stories. We're going to get you in a story. So go follow us. Check out Risk Reversal Media. Check Guy.Adami. Check out Dan S. Nathan. And we're going to start putting a lot more content on those sites. So check it out. All right, Guy, before we get out of here, let's hit a couple of things. I thought this was kind of interesting. Sam, one of our listeners the other day, hit me with NYSE new 52-week highs versus new 52-week lows. Our friend Doug Cass over there at Seabreeze, who writes for Real Money, he tracks this sort of data too. Now, every day, the financial media is reporting on this stuff, but sometimes it's just kind of noise, right? Like what catches my eyes when it feels like the market is at an inflection point, when there seems to be a common narrative about the market, and then when you see highs or lows at a multiple of one versus the other. And again, the S&P is up 9% of the year. You'd think that's a good year, but look at this. Look at the highs, new 52-week highs versus new 52-week lows. And again, Guy, a lot of these new 52-week lows, these stocks were trading at 52-week highs not long ago. Talk to me how you use this sort of data, how you think about this sort of data.
Market internals. I mean, this speaks to, so, the first thing we look at, we all do, we're all guilty of it. You look at the major indices, you look at the Dow, you look at the NASDAQ, you look at the S&P 500, and they tell their own story. And you can sort of make an assessment as to what's going on based on that. But then you start to get a little more granular and say, wait a second, given the fact that the market's up today, this should be the exact opposite. And to your point, we're not seeing that. And what sticks out to me is, almost 5-to-1 in terms of new 52-week lows to new 52-week highs. That speaks to internals that I don't think are all that strong. And we'll see how it plays out. Now, you don't trade the market just on the back of internals, but you have to take it into consideration. And your point about stocks that are now trading at a 52-week low that seemingly, a month or so ago were at 52-week highs. I mean, go no further than Caterpillar. I mean, that's a stock back in August. I mean, that's just a few months ago, Dan. This stock was making, I think, an all-time high, if I'm not mistaken.
Yes,
and now here we are. We're not making a 52-week low. I think the low is 204. So, but it's obviously had a precipitous sell-off. So that's going to fall into that category as well. You throw in an SD Lauder. I mean, there are a litany of companies that sort of fall into that.
Throw up McDonald's, because I think this is a great example. I mean, this is one that did it. I mean, this is a household name. You know what I mean? 52-week. I think that's longer than 52 weeks, isn't it? I mean, it just did it. There you go. All right, let's look at a name that you brought up, though, one making a 52-week high. And I thought this was really interesting because the gap that it had it on news. This is Garmin. And, this is not a stock that we talk a lot about. I was really happy for you to mention it because it is interesting to see stocks that are performing this way. It's not one that we talk about in Fast Money, but somebody's out there buying the hell out of this thing, right? And when you think about the quarter and the guidance that they gave, you look at this stock and you say to yourself, okay, mid to high single digits earnings and sales growth, trading at about 19 times. It's above a market multiple, no debt. Lots of cash, 15% of their market cap is in cash. It's a $21 billion market cap company, so not an insignificant sort of company. And I do think it's interesting to try to figure out, okay, what's going on here? How can I extrapolate that to somewhere else? Are they taking share versus somebody? That's how I think about these stories. It doesn't always have to be a trade in one of these names, but it's worthwhile to keep, to kind of keep a lot of other tickers that are not on your kind of like the tip of your tongue every day to see what else is going on out there.
They've got, a lot of people, listen, this was a darling into 2021 for a myriad of different reasons. I think this was probably a COVID hero in some way, shape, or form. If we go back longer, you can take a look at where the stock was. Again, not that it matters, but then the indictment of this company is just a hardware company. Why are you paying that type of valuation? They've seemingly sort of morphed themselves a little bit into a sort of an amalgam of both of those things. And now here we are now. This is a pretty clear breakout of a sideways action we've seen for the better part of this year. I don't have the short interest in front of me. My sense is it's probably somewhat robust enough to sort of get the stock back on its horse. It's already traded 1.5 million shares. It's about 2 times normal volume. This stock could sort of gravitate, or I shouldn't say gravitate, levitate up to 125 or so and still be in this pretty significant downtrend that we've been in. So I think this is one you should look at. Understand that they have 12.5% revenue growth, valuation, a little bit north of a market multiple, but not ridiculous in this environment. So my inclination is to stay with us on the long side.
All right, so one dog goes one way, one goes the other. What do you want from me, Guy? Look at this Estee Lauder. You just mentioned this, making new 52-week lows today. I mean, this thing is disgusting. This stock was already trading horribly, over the last year or so. And look at this gap lower. And you know what's interesting to me about this? This is a $38 billion market cap company. They have $10 billion in debt. But coming into 2020, Guy, they had about $3.5 billion in debt, So they ramped it up in 2020. They took on about $5 billion in debt. Do you remember where yields were back then, Guy? You know what I mean?
Like zero.
Yeah, so like at some point, You know what I mean? Like this debt is going to have to be repaid, right? Or it's going to be, like refinanced. I mean, I think some of that stuff is probably weighing on some of these companies. And if you think about this, okay, obviously this is a consumer discretionary company. Earnings, are declining. If we look at the revenue number here, they're expected to be up single digits. It trades at about 20 times next year, 30 times this year, the existing year. It's an expensive stock that for some reason I haven't taken that close a look at it. Doesn't seem to be executing particularly well. And this is one of those earnings reports that it might make sense for you if you're focused on the consumer, if you're focused on international, if you're focused on inflationary pressures and supply chain stuff. Let's go see what they have to say. This is on my list to look at later on this week.
This encapsulates everything that's going on. The health of the consumer, right? Valuations that you just mentioned. International exposure, without question. But most importantly, the difference between this company when rates were zero and what it's trading like now. And that's what you find yourself in. And it's not just going to be Estee Lauder that finds itself under this type of microscope. There are other companies out there, and this is a company that's making a 7-year low as we talk. So I think we bring it up, not necessarily tell you to go out there and trade Estee Lauder, but listen to what they have to say and then try to connect the dots to some other companies that might find themselves under similar circumstances.
All right, let's do the same thing in chips before we get out of here. This is, I promise you, the last thing here, people. Okay, let's look at AMD. You and I previewed it yesterday. You actually thought in and around, I don't know, $90 or so. It was maybe $93 or something like that. You thought the setup looked pretty good. You thought expectations were not particularly high. You were thinking a little bit about the investor reaction to Intel right after their report on Thursday. We talked about it yesterday. They're going to be talking about their higher end graphics chips that are going to be going into trading generative AI models, competing with NVIDIA and the like. You actually said on CNBC's Fast Money, as the earnings and the guidance came out, you didn't know why it was down 3 or 4%. I didn't think the guidance that they gave for the December quarter, it was plus or minus 300 on a $6.1 billion number when expectations were 6.4. Again, I thought, okay, but then they made a couple, it seemed like anecdotal comments, Guy, about this graphics chip and what it's going to be in the December quarter and what it's going to be in 2024. But that sparked a really big rally. Think about it. It's up, I think, 11% off those aftermarket lows last night here. But you see the lines that we've drawn here in this downtrend. This is probably not one you're chasing. Give me your
Not now. I don't think you chase it now. But to your point, we started the show Fast Money last night talking about AMD. Christina Partsinevelos broke it down. Tim asked a question. Mel came to me. I think the stock was trading at 94-ish. And, I'm paraphrasing, but I said, it's interesting. The setup here is actually we've round turned that move since May when the stock closed around $90. I said, the problem with the AMD is people zig when they should zag. And now's not the time to sell the stock. Now's the time to buy the stock. And that just was blind luck. But, went from 94 or so to see where it's trading now. If you're chasing it here, I think you're making a mistake. You're probably going to get a bit of a back and fill here. And we're going to sort of sort things out. But, that's why you have to interpret some of these earnings releases. You have to understand where the stock is, where it's been, what the expectations were, look at past levels, and then try to make a thesis or an investment decision or trading decision based on that.
Yeah, so last thing, though, let's look at Microchip because they report, this is MCHP. They report tomorrow. This is Thursday after the close. This is a $38 billion market cap company. Some of their biggest end markets are contract manufacturers. And just look at how the stock is traded. That was an all-time high, people, that was making earlier this year. We kind of highlight what looks to us like a head and shoulders top. Look at how the stock is trading right here. And Guy, I'll just mention this, man. Some of the end markets that they sell into, we've heard there's trying to be some stabilization in the like here, but this stock acts like, death. Trades at about 11 times earnings, growth, both earnings and sales expected to be like low single digits or something like that. So, when I look at a stock like this, look at that, and that's a multi-year basis. It looks like the risk. And again, this is why, oftentimes we cite valuation, but sometimes you want to be buying expensive stocks. You know what I mean? Not buying cheap stocks, because this is a cheap stock that trades like something bad's about to happen.
This is one of those AI proxies, NVIDIA proxies that, when NVIDIA, it's not coincidental, by the way, that, this price action has sort of mirrored what we've seen in NVIDIA over the last few months. And to your point, I don't think you have to trade this thing, but you should absolutely watch this thing because, if you see a significant breakdown from $70 down to, the mid 50s or so and traded levels we saw the summer of last year, that's problematic. It's going to be interesting to see how that weighs on NVIDIA and some of those other AI plays.
Yeah. And just lastly, okay, I promise lastly, NVIDIA, you highlighted it earlier in the week, that $400 level, Guy. I think we were doing market call on Tuesday, and it just broke in below 400. To me, there's a little battle going on at that kind of 400 level because below that, you just have that gap fill that down to $300. And, from 500 to 300, you can do that math. That's a 30% retracement. And listen, people, I could see that happening in the not so distant future. This company's going to report in 3 weeks. And then the other one that's got a nice round number that's contending that I think is also a big, name from a sentiment standpoint is Tesla. And listen, you know what? Pull up the Tesla chart really quickly. You could say it came back to that $200 level here, and maybe it looked like it's trying to put in a little bottom, and maybe you get to move back towards that kind of 237 or 235 or something. That's the gap level, Guy, after earnings from a couple weeks ago. But man, I feel like a lot of these stocks are in patterns where if they rally, I want to sell them, Guy.
I think that's right. And I think NVIDIA's going to be one of those. Well, you said it at the beginning of the show that, it used to be Apple that if you said something even remotely negative, the vitriol that you get back vis-a-vis social media would be remarkable. It's moved that sort of, that flag, I guess, has been moved to both NVIDIA and Tesla, but doesn't mean that those stocks don't set up similarly in terms of what we're seeing. So I think you're sort of in a sell rally mode for both NVIDIA, Tesla, and quite frankly, Apple as well, if you get a bounce.
Fair enough. Yeah. Hey, we're going to do something. Maybe tomorrow we'll do Amazon because Amazon's bounced 15% in a straight line. And that's when I actually want to look to fade. So maybe we'll use some options to do that. So tune in tomorrow on Market Call. We have EY from SoFi. That would be Liz Young. And of course, we are going to have the data from the Senior Earnings Insight Analyst over there at FactSet on tomorrow's show. What do you?
Let's bring in our panel. Fundstrat Global Advisors Managing Partner, Mr. Tom Lee, and Senior VP at Morgan Stanley Private Wealth Management, Katerina Simonetti. Katerina and Tom, thank you both for joining us. Katerina, the market seemed to like it, didn't love it, sort of a strong like, if you will. Should it have, or did we misread it somehow from the Fed today?
Well, Brian, today's pause by Federal Reserve was highly anticipated by the market. Rates on bonds have been going up for the last couple of months. So in essence, the bond market has been doing Fed's job. And in their statement today, the Fed did mention the tightening credit and financial environment, which pushes the cost of borrowing both on credit cards and on mortgages and of course on corporate loans, and is having a profound effect on the corporate and consumer confidence. And it's only the matter of time that is going to be translated into earnings. And while Fed might be done raising rates, we're not quite at the point where they're ready to cut yet. And this means that this narrative of higher for longer might be here to stay.
Tom, if the Fed is, or the bond market is doing the Fed's job, then what is the Fed's job? Like if the bond market is moving yields around, why has the Fed, until today, continued to aggressively raise rates? If to Katerina's point, the bond market knew this was going to be the path.
Well, I think today might have been the first press conference where the Fed is shifting away from data dependence. Because
explain.
Well, a couple things came up. One was a question about, hey, you mentioned inflation expectations jumped, and Powell was quick to dismiss it, saying, look, a lot of other surveys show inflation's in a good place, expectations. And then the question came up about, above average growth. If the Fed was data dependent, they'd be wanting to sort of push that down, but they said they could see labor supply dynamics driving that. And thirdly, they noted progress on the PCE report from last month. I mean, that's a forward-looking view because on an absolute basis, that's still a hot number.
So you think they're going with the gut? If they're not going to be data dependent entirely, are they just going with all the fields or what?
Well, that would allow them to look at the move in long-term rates and say that's 4 hikes, and that allows them to be patient. And then I think as long as inflation expectations are anchored and businesses don't pass on price increases, I think inflation is going to cool pretty quickly.
Katerina, in 1994, the Federal Reserve raised interest rates 2.5%. We call it 250 basis points in the biz. And in 95, the Dow had one of its best years ever, rising 33%. A lot of worries about the economy right now, and have been, by the way, for about two years, and they've been wrong. Are you anticipating a strong stock market going forward?
Well, Brian, I agree with Tom. We have to look at the Fed's action and figure out how much of it is actually data dependency and how much of it is just them buying time and going with this narrative, just giving their policy time to work and hoping that inflation is going to actually come down to the levels that they're looking for without pushing us into the economic recession. But meanwhile, we see higher interest rate affecting the potential earnings and narrowing the margins and are making it difficult to be excited about the fourth quarter rally. And as a matter of fact, our outlook for the next year is becoming a little bit less optimistic as the risks of the stock market are skewed to the negative. So we're telling clients to stay defensive.
But you wouldn't call yourself bearish, would you? Just kind of
not quite. I would call it being defensive, excited about cash, excited about bonds, and looking at the sectors of the stock market that are positioned for growth, which might not be the sectors that performed well, like industrials, financials, energy, and healthcare.
Tom, are you still bullish?
Yeah.
Okay.
I think that
this little blip in October didn't scare you off?
There was a lot of technical damage under the surface, and so it's going to take time to repair. That's why I think it's a baby rally that started this week. But, if next year the Fed feels comfortable and inflation's heading in the right place and investors feel like inflation is kind of leaving the scene, I think there'd be a lot of positive changes in sentiment and a huge allocation back into stocks. And, I think long-term rates would come down. I mean, to me, that's...
When we got to get to soundbite, I hear that, but Tom, quickly, when we get our first sniff of a rate cut, is that a sign to sell or a sign to buy?
I think there is so much money that has moved out of equities, right? Equities have not even seen inflows all year that I think it will be a real change in the market's behavior. Okay. I mean, it's going to look like a bull market.
Today's episode is brought to you by MetaMask Portfolio. You'll be hearing more about them later on, but for now, let's get into today's interview.
All right, everyone. Welcome back to another episode of Forward Marginal Guidance, where Jack Farley and I team up here in a combination of On the Margin and Forward Guidance. And we've got Michael Cow with us today. So, Michael, welcome to the show.
Yeah, thanks for having me back. I'm flattered to have both of you. Awesome. Two of my favorite interviewers.
Great to be here. Looking forward to it.
That's so kind. And thank you for laughing at forward marginal guidance. That is very kind of you. Very generous. All right, we've got a lot of ground to cover today. So obviously we're going live here right after the FOMC. So definitely want to get your take on that. We also had the QRA, the quarterly refunding announcement that went live earlier today, and there was a little bit of movement there. So I want to get your takes. I know you've also been talking about the Bank of Japan and the move in the dollar yen cross. So those are sort of maybe the major areas that we want to cover with you here today. And hopefully by touching on all of those different areas, we're going to tease out your macro framework. But let's start with the FOMC, Michael. So obviously we are staying pat. There's no additional rate hike from Powell. We got a slight move down in the 2-year as stocks responded positively, at least at the current time. This is just a couple minutes after the FOMC. But Powell did reiterate over and over again that they are not even thinking about rate cuts, which a lot of the reporters were keen to ask him about. So before we go into too many of the details, Michael, what did you think about this week's presser?
Yeah, I mean, look, this morning I made a prediction, which looks like it's going to be wrong. Well, unless something really changes in the last 45 minutes. But I thought that this morning we would rally based on the quarterly refunding announcement, that they would have a slightly more favorable mix of more bills and less duration, right? And so I thought we would rally on that. And then Powell pretty much said everything I expected him to say, verbiage-wise, but I did not expect the market to rally on this, because to me, I think the key statement is that they're not even thinking about cuts. And in fact, the real policy question that the committee is still wrestling with is whether or not they're restrictive enough. I think a lot of market participants, and certainly the market reaction, seems to be breathing a sigh that maybe we have seen the last of the cuts. To me, that's almost irrelevant, because I think, maybe about a month or two ago, I wrote this thread called the 4 Horsemen of Economic Resilience, as a paying homage to my favorite band, Metallica, and talking about the 4 Horsemen of Economic Resilience being the underlying demographic structural underpinnings to the stickiness in both shelter and labor inflation as the first horseman. Second horseman, probably the biggest horseman, is this fiscal tailwind, right? Some of which is left over from the COVID area fiscal stimulus, but some of which is also forward-looking in the 3 bills that this administration has passed: the bipartisan infrastructure bill, the Inflation Reduction Act, and the CHIPS Act, which I think together account for almost like $2 trillion of more fiscal stimulus. The third horseman being the U.S. consumer and corporations' relative rate insensitivity relative to other consumers and corporations around the world. So, for instance, we have 16 trillion of corporate debt, less than 25% of which is floating rate. In Europe, that number is closer to 75%. Similarly, on the homeowner front, on the mortgage front, the U.S. sports one of the lowest percentages of floating rate mortgages. It's de minimis. And that's just not the case for much of the rest of the world. That's the third horseman. The fourth horseman is this notion of energy independence. And I put that in air quotes because I don't think that energy independence is going to be here to stay forever. But in the near term, we are still the largest net exporter, exporting 13 million barrels per day. And so when you compare and contrast these pillars of economic resilience, you could argue that, okay, maybe the countries of Europe have some of the structural demographic issues that are causing labor stickiness there, but no other major economy has spent to the degree that we've spent on the fiscal end of things. I call it the vodka Red Bull effect, right? Because just as the Fed has been trying its hardest to administer a depressant, other branches of the government continue to pour on the Red Bull. And so it's really neutralizing a lot of the Fed's efforts. So to me, the big picture read-through here is the Fed is through higher for much longer, is going to be higher for much longer than the rest of the world can handle. And what that means is that at this stage of the game, the dollar wrecking ball is not going to be driven by the Fed out-hawking the rest of the world. It will be driven by the rest of the world buckling and out-doving the Fed. And let's put it this way: in Asia, that never even stopped, right? Like, we talked about the Bank of Japan briefly. I mean, last time they did a tweak of yield curve control, it was within 48 hours they were buying JGBs. This time it was within 24 hours. So then the other thing I'll mention is that given the bear steepening we've seen in our long end, who cares? The Bank of Japan deliberately didn't put a target on its new sort of no pass line for the JGB yield. But I mean, even if they, moved it to say 150 basis points, who cares when the US 10-year is yielding almost 5? So I really think that the US dollar wrecking ball remains the primary wrecking ball to watch. And yeah, so I guess let's you decide to pull on whatever threads you want to pull on out of that. I just don't think that this risk-on rally is going to last.
Are you a business owner? Does this sound familiar? I was embarrassed of my website and I needed some professional help.
So I think there's a bunch of ways we could go there, Michael, but maybe one thing to pull on in the last interview that you and I had, just going off the global conversation here and the impact of the US dollar wrecking ball and the Fed's monetary policy as opposed to that of other global central banks. You pointed out this very interesting differential in between the 2s and 10s spread in the US and across other economies. So I'm actually going to share my screen quickly here. So this is a visualization of what rates are doing in the US, the 2-year, the 10-year, and the 30-year. So if you're following along on video, this is over a 3-month time horizon, and you can see this, the teal and the orange chart there, the 30-year and the 10-year, and that is screaming up to meet the 2-year and essentially uninvert. We still aren't there as of today. So you can see the reaction in the market post today's presser. Yields are down across the entire curve, and we're still looking at a yield curve that's somewhat inverted. And at least in my head, what I was sort of looking for is, okay, there's an impact to risk premia here. We need to see the yield curve eventually sell off or fully uninvert, and then that'll be sort of maybe the end to this part of the cycle. We haven't really seen that. So can you talk to us about how you're looking at?
Yeah, let me say something else though. It's not even okay. So I have a pinned thread right now that's called Revisiting Bear Steepening, Recency Bias, and that 70s show. And so in it, I have a chart that I want to call attention to. It's towards the.
We can put it up. Yeah. Not now, but later.
So the chart is basically where I'm comparing the recent bear steepening to what happened in the 79 to 82 sequence, right? So I originally bought a little bit of TLT as kind of like a counter hedge against a bunch of my like high duration risk shorts. Okay. But I actually, after doing the research and writing this thread, I actually said, you know what, fuck this. I don't want to own that duration. I don't want to own duration in any asset class. And I'll get into that later, because what you see, I don't know if you can pull it up on your screen, but it's the chart where I'm comparing the yield curve in 79, 80, 81, and 82. So I think this is critical, right? Because what you see happen is that for the first 3 years in 79, 80, and 81, right, the Fed hiked the front end aggressively. And, just similar to what we had now, initially, you saw a muted reaction in the long end, and then eventually the long end repriced in a bout of bear steepening, and it happened like 3 different times. But it's the 82 bull steepening that scares the shit out of me, because by the time 82 comes around, right, the Fed started easing the front end, and the back end completely blew out, because it was the market's way of saying, we don't believe that. At that point, inflation expectations had become so ingrained in the zeitgeist of society that by the time the Fed started pulling its reins back on the front end, the back end just blew out. It totally blew out. So that was the curve, the 82 curve. That's the one that scares the shit out of me. And in that, I'm sure you guys all watched the Paul Tudor Jones interview of Druckenmiller, but I think he actually obliquely referenced that as well, talking about how the reason why he's got this bull steepener on is that at some point the market loses faith in the Fed's ability. So I actually think that, I've been voicing a very unpopular opinion that I think the Fed has made a mistake by pausing the last 2 meetings. I actually think that what they did, I've been looking over the last 2 FOMC meetings for the Fed to talk about the effect of spreading strikes that have jumped across industries. First, it was Hollywood, and I could basically chalk off, I know a lot about the Hollywood strike given where I live. And, I would argue that had less to do with overall cost of living pressure as it had to do with basically the inequities introduced by streaming dynamics. Okay. But what you've seen happen is that dynamic, right, has jumped industries into autos, into airlines, into healthcare. And you just saw that the United Auto Workers Union just basically cinched a 25% wage hike. The pilots union, even though they didn't officially strike, actually secured 40% wage concessions. So like Jay Powell can talk about how, yes, we're seeing some moderation in wage pressure. I guess that's before all of these unions have locked in structural price hikes. So my friends, I think the dreaded wage price spiral is here. And so I think Jay Powell is actually kind of pulling an Arthur Burns here by waiting.
Today's interview is brought to you by MetaMask Portfolio, your one-stop shop to manage your crypto assets and access a range of Web3 services all in one place. Overseeing your crypto assets across different wallets and networks can be very complicated. MetaMask Portfolio solves this by giving you the reins to manage your crypto from a single decentralized application or dApp. Just connect to MetaMask Portfolio to get a bird's eye view of all your coins, tokens, and NFTs, and you can easily buy, sell, swap, bridge, and stake crypto assets at competitive rates right within the app from a vetted list of providers. No more jumping between dozens of sites and apps. MetaMask Portfolio lets you do more in Web3 your way, giving you secure and convenient access to a wide range of features and services all in one place. Manage your portfolio your way with MetaMask Portfolio. Click the link in the description of today's episode to get started. Thanks, let's get back to the interview.
To be honest.
So what do you think the level of appropriate interest rates is if it's not 5.25 where they are now?
Well, look, it's not so much the level of interest rates, but it's what is he needed to basically sledgehammer this economy into submission and basically create enough job losses, I hate to say it, to lower aggregate demand. His life has been made very, very difficult because of the fiscal tailwind, and that's not their fault. But I think it's problematic, I think, in the end, for them to be waiting, because I feel like this is the team transitory thing all over again. And if they wait and wind up having to restart a hiking cycle, that's going to be a much more painful rug pull than if they went ahead with what was already priced into the dot plots to begin with.
So I'm just going to take a little spin back. So yeah, in the morning, Treasury released how it's going to fund itself. And I know you guys know this, but for the audience, like Congress decides how much it wants to spend or how much it wants to borrow. It's Treasury's job just decide how are we going to borrow. Are we going to issue short-term bills or those longer-term notes and bonds? And I think the announcement today is that it's going to use a lot more bills than the market was expecting, than the primary dealer community was expecting, and that they may do some meaningful deviation from the relative like 15 to 20% split of bills. So they're going to issue short dated bills, which is stimulative. And if you were a corporation, you would, and where you have an inverted yield curve, you probably want to issue longer term coupon debt, 10-year, 30-year, because those yields are higher.
The point of my pin thread, though, was to talk about how, look, I actually think that there's too much emphasis that a lot of macro pundits are putting on the quarterly refunding. And I honestly think that ultimately it's macro gravity that's driving the bear steepening in the first place. And back to what you were referring to, that I had referred to on our past interview about like the global yield curve. So I have that pulled up once again. And, my view was that, in July, when the yield curve was 110 basis points inverted, I was simultaneously looking at, for instance, GDP and inflation data across the world, across like the major central banks. And, the other 2s, 10s curves that I was comparing to the US to were Germany, China, Japan, and Italy. And I'm like, okay, how does it make sense that our 2s, 10s is 110 inverted, by far the most inverted of all these world yield curves? Just by reference, at that point in time, the Japanese yield curve was positive like 55 bips, and the Italy yield curve was positive about 60 bips. But their economies are so much weaker than ours. How does that make any sense at all?
Because the Fed tightened more
than
they did.
But my point is that the long end was mispriced. The long end was fundamentally mispriced. And so that leads me to another big conflation argument, which has to do with the overemphasis on the quarterly refunding, which is, oh my God, who's going to buy our debt? No one's going to buy our debt. And, any additional iota of duration is going to crush the bond market because people are scared about the creditworthiness of the United States. No, I completely disagree with that. I think that it has to do with fundamental macro repricing of where it should be. And I think that ultimately it's higher for longer that is repricing the long end. And, I think what higher for longer, once it really seeps in and people really appreciate the gravity of it, what it does is it precipitates a wealth transfer from high duration assets to short duration assets. You're seeing that in the bear steepening, but I've been really thinking about how I want to position my own portfolio from it. And, we can talk about that, but effectively, that's what I'm doing too. I'm trying to own assets whose valuations are primarily determined by short-term cash flows as opposed to terminal value. And I want to be short the opposite. I want to be short asset classes whose primary valuations are based upon terminal value as opposed to current cash flow. Does that make any sense?
Yeah. Let me sum up, because there's a lot of meat here, and this is something that we wanted to get into with Michael. So the quarterly refunding announcement, just to sum up, what Jack was saying before, Congress obviously decides how much money the United States is going to spend, and then it's on the Treasury to essentially decide how to fund that. And this 15 to 20%, Jack, that you were referring to, is sort of what the market thinks, and this is what how the mix of bills, very short-term bills versus longer-term bonds that the Treasury has currently or has historically opted for. Now, the reason that's generally significant, we had Andy Constant and Nick Giovanni, the two great beards on the show just a couple of weeks ago, talking about the significance of that percentage and how the Treasury and Janet Yellen were a little bit in between a rock and a hard place, because on the one hand, the amount of supply that was coming to the market is pretty stupendous, sort of this tsunami of supply, which is causing a repricing in the end of the curve. So that'd be the supply argument, as opposed to, Michael, sort of the macro gravity argument of higher for longer reality setting in that you're giving. I don't think those are mutually exclusive, by the way. I think there could be.
They're definitely not, because there's a price for everything, right? And so if the curve were priced appropriately in the first place, then you would have the demand appetite. But right. So that would be my argument. They're definitely not mutually exclusive. They're related. But my point is that the macro is what determines the price. Price is what determines demand.
Right. So 100%. So a new clearing rate needs to be decided on, especially for the longer end of the curve, which is presumably what's happening right now, right? That's why we're watching this repricing in real time. But my question to you is, this was Andy and Nick's point, maybe we should get them back on the show as well, was that the reason that the Treasury was in a little bit of a tough spot here is because it's that 15 to 20% could be a little bit of a tell for the market. So on the one hand, where they could go wrong is bring way more bonds to market than there is demand, which you could see sort of a less orderly repricing in terms of that longer dated debt. Or on the other hand, the other option that they have is to issue more bills and go above the 15 to 20% ratio that they've historically held. But in a sense, that also signals to the market, like, hey, we're actually a little bit worried here, right? So we're going to break this pattern that we've historically held, and it signals that there's a problem to the market. So I'm curious, Michael, like how much do you think that signal really matters here? And then I've got some more sort of specific questions about the higher for longer.
To be honest, I haven't focused on that aspect. You raise an interesting point about the signaling, and I haven't really thought deeply about that, because I think again, for me, my guiding principle is the underlying macro and what determines the price in the first place. And I think, to me, that's the bigger issue, right? I think what you asked the right question. What is the new clearing price? And that Druckenmiller interview really, it's when he pointed out about how everybody under the sun refied except the U.S. government. I mean, it's super, super frustrating to hear, because and it's true, because when I wrote that bear steepener thread last summer, it was exactly this idea that we need to think out of the box here. And the Fed, in conjunction with Treasury, could have issued as much duration as they wanted. So what if they reprice the 30-year from 180 to 230, or even 3.5%. But like, I was basically envisaging a solution where, let's say that the Treasury, in conjunction with the Fed, decided to engineer a bear steepener that took our yield curve to 3% to 6% on the long end. But and to get to that 6%, we would have termed out a shitload of debt along the way, right? At much lower coupons. But if we had done that, maybe the Fed didn't have to take the short end to 5.5%. Maybe they could have stopped at 3 and kept the yield curve normal shape. Now, something like that has never been done before. But again, to me, that was like a first principles solution to a pretty tough problem. But now I fear that we are now in the late 70s, early 80s dynamic, where we're gonna have our cake and eat it too, in a bad way. We've now hiked the front end to 5.5%, which has already caused some problems. It's going to cause further problems, but now the long end is starting to reprice itself, and we may wind up getting the bear steepener, further bear steepening, followed by eventually a bull steepener. And that to me it's that 82 dynamic that scares me, where like that eventual bull steepener, like in today's yield curve, that would take the 30-year to like 7 or 8%.
Sure, but Michael, that was coming out of a recession, and we haven't had a recession yet.
Correct. Yeah.
And it sounds like you don't expect a recession. It sounds like you're a pretty big bull on U.S. economic activity.
No, you're mistaking me. I think that in the end, the Fed will sledgehammer this thing, but they are doing too slow of a job in doing it. It will happen, but it's taking too long. And so I think that it would have been better to pull the Band-Aid off and do it quicker than to drag this thing out. And I think that they're now running the risk of dragging this thing out. The recession is going to come. I have no doubt it's coming, but it's definitely been pushed off. I originally thought, right, that by Q4 of this year, we would start to really see unemployment start picking up. and potential recession. We're nowhere near that. We just printed this 4.9%.
And it wasn't just you, Mike. I'd say that was mainstream opinion a year ago, and even going into this year.
Yeah.
And with the bank failures, and Nick Timmer's questions today to Powell about, and it's funny, we haven't really talked about the Fed meeting, of saying 500 basis points of increase in rates, a small banking crisis, and then quantitative tightening. It's not enough to derail the economy from it's below trend potential. So, Michael, I'm curious as well about the structural demand for treasuries. You talked about, I don't think it's about the supply. I think it's the macro drivers. The economy performing better than expected. It definitely is that. But
well, that's the demand side, right? Because like the quarterly refund stuff is focused on supply dynamics.
That's part of the demand of people who have money and who can spend it across the fixed income spectrum. Do they want to buy a lot of duration if the economy is better than expected? No, they don't. Yes, but there's also how much money is there to buy stuff, and that goes into something in the QRA that was referenced today, such as a strong dollar. Disinclines other foreign central banks. They have to sell dollars in order to defend their currency. Stuff that I don't really understand with the Japanese yield curve. Because you said if Bank of Japan, if yields on JGBs are close to zero, and in the US they're 10 years. But I think the way that the yield curves are is like the hedging cost is actually making it's for a Japanese investor. It actually is a worse time to buy treasuries now that they're at 5% than when they were at 2%. And also something that where I've done my own work on this is just the commercial bank holdings of treasuries. They bought so many treasuries and agency mortgage backs in 2020 and 2021, and their ability to absorb more paper and more issuance as the amount of bank deposits is going down is limited. And
and related to that, their ability to issue loans, right, extend loans is limited because they're tied up, right? They're not able to essentially do anything, because to do anything to liquefy their held to maturity portfolio would be to crystallize losses. So I think these are all arguments in favor of recession coming, but it's definitely been prolonged. I mean, I've been one out of the box trade that I've been doing as a way of having short duration current yield is I've been buying closed-ended funds on CLO equity. And if you know how CLOs work, right? I mean, it's a cash flow. You're basically getting the waterfall of cash flows after like the AAAs down to the BBBs have been paid off, right? But would you believe that I'm basically getting, as of last week, I was buying this stuff at 25% current yields.
No,
right? 25%.
I thought you were saying 12, and I was going to pretend to be surprised, but now I actually am surprised.
25% current yields. And well, this week it kind of repriced. Now they're only 22.5% current yields. But I mean, what I had a chat with the portfolio manager of the CLO equity manager today, and it's the same thing. I mean, senior loans. What the default rate is? It's 1.3%, and I'm shocked. Right? Like I thought that the way bank loans and leveraged loans work is that they're typically SOFR based, SOFR plus a spread, right? And so when SOFR goes from 0 to 5, a small business that has one of these loans on basically has seen their cost of debt capital go from 5% to 10%. And that's, I'm involved in one small cap where, that's the harsh reality, and they're forced to basically sell business units to delever, right? And so I'm surprised on the one hand that this huge jump in the risk-free rate at the front end hasn't resulted in higher defaults, but I think it has to do with the macro tailwind, because this CLO equity PM was telling me today that the credit metrics have remained relatively sanguine mainly because the top lines of these businesses have remained resilient, which is pretty incredible if you think about it, right? Like 1.3% default rates. The 10-year average, by the way, for bank loan default rates is more like 3%. And to put things into perspective, during the great financial crisis, we briefly touched at 11% default rates. We're at 1.3% right now with 11 rate hikes and Fed funds at 5.5%.
Yeah, so I assume a lot of those are commercial and industrial ones. And I know that this argument has been said by people who've been wrong, that they're lagging, but they are lagging. So, that is, the 1.3% is going to be higher.
It will be. Sure.
But you're right. Credit has performed much better than pretty much everyone expected. What a lot of people expected. What was I going to say? Michael, what were those CLO equity yields like a year ago or 2 years ago? Because, yeah, I know senior loans are at 10%. So their spread is like 4% or 4.5%. So, but the spreads in leveraged loans, not CLO equity, I know are somewhat complacent, and that you're in the same way in high yield, you're not getting that much spread. Yes, the yield has gone up because the Fed raised interest rates, but the spread is not huge, indicating any distress as well. So even though the realized default is low, what the market is pricing for implied default as well is low. So,
that's exactly right.
Yeah. So, but so is 25%, is it really like, obviously that's, pretty decent yield.
Part of this was an idiosyncratic dynamic with these closed-end funds where there was a retail just shit the bed, because like in 2 days, this thing repriced from 7% discount to NAV to now it's trading at 5% premium to NAV. Historically, though, these closed-ended funds, because of their yield, trade at like 20 to 40% premiums to NAV, to give you an idea of how cheap things got last week. So that was my big trade last week. But I think it's an interesting, I tweeted today that back to my comment earlier about how I think what higher for longer portends is generally a transfer of wealth from high duration to short duration. So I think of my own portfolio as kind of a macro capital structure arb, where I'm barbelled between, for instance, a big T-bill ladder at the 1 year point or less, right? And then I have this closed-ended fund in CLO equity, which is also, if you think about it, it's also a short duration credit instrument, because at the end of the day, right, when you think about how to value an asset, the cash flow part of the DCF is so dominant relative to the terminal value. That's what makes it a short duration asset, versus a lot of growth stocks where that mix is exactly opposite, where the entire valuation is not on current cash flow and all on terminal value, on the come value, right? So I want to be short the latter, I want to be long the former.
Yeah, and
I'm very impressed with everything you continue to add to Giru. This may be one of the best tools for digital marketers available.
Duration, floating rate loans, by definition, have a very low duration. Sorry, floating rate
Well,
loans.
interest rate wise, they have no duration.
Right, exactly. Yeah.
By definition. But I'm talking even from a credit standpoint, because the cash on cash yield is so high, it relegates the terminal value component of valuation to a relatively unimportant component of overall value, if that makes sense.
Yep. But in equity, the duration is a rigid concept in credit and fixed income. In equity, it's kind of just a narrative, like, oh, NVIDIA is a long duration asset, but NVIDIA is.
Oh, it totally is. I mean, that's a perfect example, right? I mean, there are current cash flows, but essentially, I mean, if you think about it, right, like any super high multiple stock is by definition a high duration equity. I had this back and forth with Bob Elliott last week, and Bob Elliott made this comment that people are going to start realizing that there are bonds in those equities, and I said that's 100% the way I've always looked at the capital structure, because
that's such a great quote. I love that quote.
It's a wonderful quote.
Yeah, that's a great quote.
I love it too, but I thought the same thing a year ago, and people did not think about the bonds in NVIDIA. They got very excited about the bonds in NVIDIA this year. And there were bonds, because bonds is fixed income and equity grows.
As a former capital structure arb, right, I've always thought of the capital stack as a continuum. If you think about it, right, the nomenclature of what makes a stock and what makes a bond, those are artificial terms. What you have is a continuum of securities that are bundles of cash flows, and as you get down towards the equity-like securities, they tend to have the more what we associate as equity-like characteristics usually refer to higher duration, right? Higher terminal value component. So I would argue, right, that as sort of a value, as a seeker of value across the capital stack, I like to look for equities with bond-like characteristics, and sometimes I like to look for bonds with equity-like characteristics. It's all a continuum. But this current macro is favoring the short duration securities, whether you're talking about equity or fixed income.
I wanna press you for more details about that, Michael. But just to return to the presser a little, and to get a sense of, I heard you say that this Powell could be going down as Arthur Burns here, and you referred a couple of times to this speech, this sort of fireside in between Paul Tudor Jones and Stan Druckenmiller when Stan Druckenmiller had some pretty choice words for Janet Yellen. I actually believe that he said this might be the largest financial mistake since the days of Alexander Hamilton, who was, I believe, he's basically the first. So yeah, no small words from Stan Druckenmiller there. I guess I'm not even saying I don't agree that this couldn't have been handled better, but let me just play devil's advocate and poke at that idea and get your thoughts. Just in terms of the hiking cycle, we started very extreme. We were in ZERP for a very long period of time. No comment on whether or not the fiscal and monetary bazooka that we fired at the US during COVID was the right move or not, but we